Welcome back to Investing Talk Podcast.
Good to be back.
We've got quite a bit of information here on a company that's, well, been seeing some really extraordinary activity lately, Regencell Bioscience Holdings.
That's the one. Definitely caught some eyes.
So our mission today is to take all this material we've gathered and really unpack it. Look at the fundamentals, the market action, the risks.
Basically, try to make sense of what's going on.
Exactly. Cut through the noise, give you the key insights quickly. And hey, if you find this useful, please do remember to subscribe, like, comment.
And maybe consider buying us a coffee. It genuinely helps us keep doing these analyses.
It really does. Okay, let's start with the basics. Regencell Bioscience itself. What kind of company are we actually looking at here?
Okay, so fundamentally, they're a biopharmaceutical company, but with a particular focus.
Right. The material mentions traditional Chinese medicine, TCM,
Yeah.
research development, maybe commercialization down the line.
That's the core idea, and specifically targeting neurocognitive disorders. Think ADHD, autism spectrum disorder, those kinds of conditions.
So the approach is, what, blending old and new. Traditional methods meets modern science.
That seems to be their pitch. Trying to develop personalized herbal formulations but validate them scientifically. Started in Hong Kong, now headquartered in the States.
All right, that gives us the basic framework. Now let's get into the financial picture. Or maybe the lack of a traditional one, as the info suggests.
Yeah, that's probably the most striking thing right off the bat when you look at the financials.
Revenue.
Zero. Nada. The company hasn't reported any revenue. Now, it's stressed that this isn't totally out of the ordinary for a development stage biotech.
But it's still a critical fact. No sales coming in the door yet.
Right. And that leads directly to the bottom line. Negative earnings per share. We see figures like minus 0.172 cents and a tiny minus 0.00099 cents more recently.
Meaning they're consistently losing money, which makes sense, right? Heavy R&D costs, no offsetting income.
Precisely. So trying to use something like a PE ratio, price to earnings, it's just not meaningful. You can't value it based on profits that don't exist.
Okay, no revenue, no profits. But the material did mention something about liquidity.
Ah, yes. That's the other side of the coin. While debt levels are described as moderate, the liquidity looks, well, very strong. There's this exceptionally high current ratio, cited 41.92.
Whoa, okay. 41.92. Break that down. What does a current ratio that high actually tell us?
So the current ratio measures if a company can pay its short-term bills debts due within a year with its short-term assets, like cash. Usually anything over 1 is considered decent.
And 41.92.
It means for every dollar they owe in the short term, they have nearly $42 in easily accessible assets. It's huge. It signals minimal short-term financial risk. They have a massive cash cushion to keep operating.
So that's a really stark contrast, isn't it? No income, but apparently flush with cash for near-term operations.
It's definitely an unusual combination highlighted in the reports. Other metrics, like free cash flow, probably negative, though no specific data was pointed out. Return on equity, not really calculable in a meaningful way yet.
So, summing up the financial snapshot. Pre-revenue, loss-making typical for the stage, but with this surprisingly large cash pile providing short-term safety. Very unusual.
That's the picture we get from the information.
Okay, let's place them in the market. Where does Regencell Bioscience fit, competitively speaking?
The reports put it squarely in the niche of herbal-based therapies within the broader biopharma space.
And in terms of a competitive edge, the material didn't seem to highlight any, commercialized products or major IP milestones made public yet.
No, not really. It's described more as an emerging player, a challenger perhaps, not an established leader by any means based on current products.
Right. And here's where things get even stranger, connecting back to the financials, the market capitalization.
Ah, yes. Valuation. The reports note it's been rising rapidly. One from May 2025 suggested around $1.2 billion, but then another from June 2025 mentioned figures closer to $30 billion.
$30 billion. That's an enormous leap in a month, especially, as we just said, for a company with no revenue. How do the reports explain that?
Well, they connected to some broader trends. High investor appetite for novel therapies, for one. Growing interest in alternative medicine.
Okay, those make sense as general sector tailwinds.
But they also stress the risks inherent in this space. Intense regulatory hurdles, market volatility tied very closely to clinical trial news.
And for this company specifically, the TCM angle must add complexity, right? Getting approval outside Asia.
Definitely. That's highlighted as a key risk. Plus, the fundamental need for solid, rigorous scientific validation of their specific formulations that global regulators will accept. That's a big hurdle.
That validation point feels crucial. Traditional use is one thing, proving it scientifically to bodies like the FDA is another game entirely.
Absolutely. And when you compare them to peers mentioned, like GW Pharma, now part of Jazz with its approved drugs and revenue, or Axum Therapeutics, the reports say Regencell is lagging way behind commercially and scientifically based on public info.
Okay, so let's recap. Pre-revenue, loss-making, but cash-rich. Niche player, emerging challenger, but with a market cap that reportedly exploded into the tens of billions recently.
Which brings us squarely to the main event in these reports. The stock's performance, the volatility.
Yeah, this seems to be the big story. Extreme swings, high volatility.
Yep.
It's all over the material. It was even flagged as a, prime short squeeze candidate?
That's right. And there was a mention of its short squeeze score jumping dramatically from 21 up to 88 in early May 2025.
Okay, maybe quickly explain that. Short squeeze, high score. What does that mean for investors?
So a short squeeze is when a stock heavily bet against by short sellers people, hoping the price drops, suddenly starts rising fast.
Right, forcing the short sellers to buy shares to cut their losses.
Exactly. That buying pushes the price up even more, forcing more shorts to buy. It can create this rapid upward spiral. A high score, like 88, suggests the conditions are ripe. Lots of short interest, maybe other technical factors making it hard for shorts to get out if the price moves against them.
And the price action certainly matched that potential. June 16th, 2025. The stock surged, over 389% at one point? After already being up massively earlier that day.
Just incredible volatility, and that triggered a trading halt, as you'd expect, the exchange stepping in to let things cool off for a moment.
And the longer view is just as wild. A one-year trend showing something like a 12,000% rise year to date, from pennies to over $26.
Phenomenal numbers. And the reports consistently frame this as reflecting speculative trading, not fundamental business changes.
Hard to argue otherwise with zero revenue. The valuation seems totally detached from current business reality.
That's the core paradox. And adding to the recent mechanics, there was that stock split.
Right, the 38-for-1 forward split took
Yeah.
effect June 17th, usually done to lower the share price, make it seem more accessible.
Increased liquidity, yeah. But the reports also note that for volatile stocks, splits themselves can sometimes attract more speculative trading, add to the momentum.
So pulling together the potential drivers for this huge surge, what's the mix according to the reports?
It seems to be a combination. Positive sentiment around clinical trials, reports of promising results, though maybe light on specifics.
Okay. Hope about future success.
Then there's a lot of anticipation, maybe speculation about partnerships or funding, talk of deals with big pharma, potential government money.
But unconfirmed stuff, mostly.
Seems that way based on the reporting. And then the technical factors around the split itself contributing to the mechanics of the move, plus a mention of a strategic pivot towards Asian markets.
Okay. Given all that the volatility, valuation disconnect, the reports must highlight some serious red flags. What are the main concerns?
Number one, repeated constantly. The lack of meaningful revenue and profits. Persistent net losses. That's the fundamental issue.
And analysts cited seem to agree it's way overvalued based on that.
Very much so. There was that quote, the incoherence is immediate. Regencell has no earnings, no EBITDA. It really hits home that standard profitability metrics just aren't there.
So other metrics, like price to book, must be sky high with that market cap. No dividend, obviously. And beta, well, not specified numerically, is described as extremely high volatility.
Correct. Then there's the high short interest we talked about. That itself is a red flag, suggesting significant skepticism from institutional or sophisticated money, even as it fuels squeeze potential.
And the sheer volatility is a risk in itself,
Yeah.
right? Massive swings cut both ways.
Absolutely. Huge potential gains, equally huge potential losses very quickly. It attracts attention, yes, but maybe not the long-term fundamentally focused investors. Plus, regulatory scrutiny can increase with moves like this.
Then there's the speculation risk. If those rumored partnerships or funding deals don't actually happen or aren't as big as hoped.
The valuation could deflate rapidly. It seems heavily built on future expectations right now, not current reality.
What about other future risks?
Well, the regulatory hurdles for TCM outside Asia remain significant. And if they need more cash down the road and commercial results aren't there, they might need to issue more stock, which could dilute existing shareholders. Plus, broader economic factors like interest rates could always dampen enthusiasm for speculative plays.
Though, it's worth noting, the reports didn't seem to mention things like major lawsuits or supply chain nightmares.
No, the risks seem very focused on the science, the regulation, the financials, and the market speculation.
Okay, that's a lot on the risk side, but let's balance the picture. What strengths or opportunities did the material point to?
There are potential positives mentioned, the unique positioning blending TCM and modern science for potentially large unmet needs in neurocognitive disorders. If they can pull it off, that niche focus could be a strength.
And the clinical trials themselves represent potential upside.
Huge potential upside. If they deliver strong, positive data that validates their treatment scientifically, that would be absolutely pivotal, a game changer for them.
And didn't we talk about their cash position earlier? That's a strength, right?
A major one, yes. Those reported reserves, nearly $3 billion mentioned in one report, give them significant financial flexibility. They can fund R&D, maybe even make acquisitions without immediately needing to tap the markets in a potentially dilutive way.
So catalysts to watch for. Definitely those trial results.
Absolutely number one. Further corporate actions like splits or capital raises could drive trading, but their fundamental impact is less clear.
And the speculated stuff. Government grants, partnerships.
Still speculative according to the reports, but yes, if any of that gets confirmed, it could be a significant boost, accelerating development or lending credibility.
So how's the market digesting all this? What's the overall sentiment? It sounds complicated.
Extremely polarized is how the reports describe it, which makes sense.
Analyst views, generally cautious.
Mostly negative or neutral, it seems. Few recommending buying at these levels, given the risk and the disconnect from fundamentals. The consensus among analysts appears to be that the rally is mostly speculative.
But then you look at social media.
And it's buzzing. Intense discussion on platforms like X, Reddit, especially after the big price moves. Lots of excitement, people talking about the surge.
But is it all just hype?
Not entirely. The reports mention that alongside the excitement, there are also cautionary voices warning people not to just chase the momentum, especially without confirmed news backing up the rumors.
So a real split view. Analysts cautious to negative, focusing on fundamentals. Social media mixed, with high excitement, but also some warnings.
That's the general picture painted by the information.
Okay, let's try to wrap this up. We've looked at Regencell Bioscience Holdings, a TCM-focused biotech. No revenue, no earnings, but somehow an explosive stock price recently leading to this multi-billion-dollar market cap.
It's quite the paradox.
The drivers seem to be this mix of technical factors like the split, hope around trial results, maybe sector momentum, and a whole lot of speculation about potential deals.
While the valuation looks, incredibly stretched compared to the actual business fundamentals, even with that strong cash position.
So it really puts you, the potential investor, in a tough spot. You're weighing this potential but very uncertain future upside if everything goes right, science, regulation, sales.
Against a very clear and present downside risk if those expectations fall flat, or if the speculative bubble, if that's what it is, bursts before the fundamentals can justify the price. It's biotech investing on steroids, almost.
So thinking about everything we've discussed from the reports, the central question maybe isn't just, will the science work? It's also, can this current huge valuation hold up until or unless the fundamentals arrive? Or is this mostly about market momentum right now? Which force do you think ultimately wins out here? Something to consider.
Definitely something to think about.